Now today, stocks erased declines, I should say erased gains into the close, but the S&P is still up 6.1% so far this quarter. Our next guest says signs point to sustained gains for stocks. Robert Maltbie is a fund manager with Millennium Asset Management, and he's joining us right now from Phoenix, Arizona. Robert, nice to have you on this day after Thanksgiving.
Thanks, Ellen. Nice to be here.
Why are you so bullish on stocks?
Well, three main reasons. Our indicators are as bullish as they've been since May '03, when the Dow is at about 8,400. Here are the reasons. Liquidity, a lot of money flowing into the market. In the last month, over $20 billion into mutual funds, very positive there. About $39 billion in corporate buyback, and another $17 billion in cash M&A. Also, valuations are very reasonable. Some may say even slightly cheap. Market's trading about 19 times free cash flow. Haven't seen that since 1990. And also on a PE basis, about 15, 16 times earnings.
Well, Robert, let me jump in here, because what's interesting is it seems like something must have shifted for you, however, because you recently covered a lot of your shorts. So give us a sense, was there a particular catalyst for that?
Well, outside of the election, just our indicators. A lot of the uncertainty's been removed, and the thing that did change, along with us, sentiment and money. The liquidity indicator got very bullish. We don't want to be in the way of that freight train.
What's interesting, though, is one of the stocks that you like, Cleveland-Cliffs, is actually one of the big short plays. About 20% of the shares currently positioned with investors expecting the stock to decline. So what do you actually like about it? Why do you think it's going to gain?
Well, right now, Nissan today underscored it. There's a shortage. There's a high demand for steel globally. China is going to absorb a lot of that. Cleveland-Cliffs is one of the world's largest suppliers of pellets, iron ore pellets, which goes into, without getting too scientific, the smelting of steel. So they're very well positioned. There's virtually no coverage of this company on the street. The easiest way to get an earnings estimate is look at maybe a value line report, and they seem to be quite off base in their estimate.
But what's interesting, those shares up 80% year to date, so someone knows about the stock.
Well, it's getting more and more exposure. We like it. It's trading about 9 times, and we're looking at earnings growing possibly 40% in the next 12 months.
Now, Robert, you were talking about valuations a minute ago. It's interesting because Google is one of the stocks you also like. Where's the opportunity, given that it's already trading for 52 times 2005 profit?
Well, the opportunity is in the fact that it's at a discount to its underlying 12-month forward growth rate of about 70%. We see earnings growing from somewhere in the ballpark of $2.5, maybe even $4.50. Also, relative to the space, it's at a 30% discount to eBay on price to sales. So it's relative and absolute price to earnings growth rate in the next 12 months.
And how high do you think Google will go?
Our target's in the ballpark of 220.
Okay, 220. Interesting to watch. A lot of people watching that. Let's move on and talk more generally about stocks versus the dollar, because I know you're making a dollar play on stocks. How specifically?
Well, emerging markets, very attractive. China, again, pegged to the dollar, benefit from the weaker dollar. Also here in the U.S., looking at companies that have exposure to capital goods exportation should do very well. I think that's kind of a key concept that's going to occur here, Ellen, in the next 6 to 12 months. It's kind of the handing of the baton from the consumer as they take a break over to corporate and capital goods consumption. So a weaker dollar is going to very much help those industries sell in the foreign market.
And Robert, in our last 15 seconds, how much of that has already played out?
I think it's very early in the game here. A lot of people are just looking at some of the more currency-related or trading aspects of the dollar rather than the emerging markets and the industrial companies. So I think there's a lot of room to go.
Robert, we're going to leave it there. Thanks so much. Have a great weekend.
Thank you.
Robert Maltbie is with Millennium Asset Management.